Imagine you own a house or an apartment, a tangible piece of your wealth, but you're moving across the world, planning for international retirement, or restructuring your family's global assets. The question becomes, how do you legally and efficiently move that property from one country's legal system to another's? This isn't like transferring a bank balance. Real estate is rooted in the soil and laws of a specific nation. The process of transferring property across borders is a complex ballet of local real estate law, international tax codes, foreign ownership regulations, and currency controls. Get one step wrong, and you could face double taxation, legal disputes over title, or even have the property frozen. The goal isn't secrecy, it's seamless, compliant transition. Today, we're mapping out this intricate process. We'll break down the two primary legal pathways for transfer, dissect the tax implications that can make or break the deal, explain how to navigate foreign bureaucracy, and highlight the indispensable team of professionals you must assemble. This is a guide to navigating a high-stakes legal landscape with precision and foresight. The first and most critical step is not a document, but a decision, understanding your objectives and the two primary methods. You must ask, why am I transferring this property? Is it for personal use in the new country, for investment management, or as part of an estate plan? The answer dictates the structure. There are two fundamental legal pathways. Method 1, the direct sale and repurchase. This is often the most straightforward. You sell the property in country A, pay any applicable capital gains taxes in country A on the profit, and then use the after-tax proceeds to purchase a new property in country B. This clears your tax obligations in the origin country and starts fresh in the destination country. However, it may trigger significant tax liabilities if the property has appreciated greatly, and you lose the benefit of any future appreciation on the original asset. Method 2, in specie transfer via a legal entity. This is more complex but can defer taxes and maintain continuity. Instead of selling, you transfer the legal ownership of the property. For individuals, this often means changing your tax residency and potentially facing an exit tax or deemed disposition rule, where the origin country treats you as having sold the property at market value upon departure, taxing the accrued gain. Alternatively, you can place the property into a corporate entity like an LLC or a holding company in country A, and then transfer the shares of that company to a trust or entity in country B. This shifts the ownership of the holding vehicle, not the land itself, which may circumvent restrictive foreign ownership laws in country B and defer capital gains taxes until the underlying property is eventually sold. Choosing between these methods is impossible without professional tax advice specific to both countries involved. Once the strategy is chosen, you collide with the most formidable aspect: international taxation and treaties. This is a minefield. You are potentially liable for tax in both countries. The key is understanding the double taxation agreement (DTA) between the two nations. A DTA is a treaty that determines which country has the primary right to tax specific types of income, like capital gains from real estate. A typical rule is that the country where the property is physically located has the right to tax gains from its sale. So, if you sell a U.S. property, the IRS and possibly the state will tax you first. Your new country of residence may also want to tax that gain. The DTA should provide a foreign tax credit mechanism, where the residence country gives you a credit for taxes paid to the source country, preventing you from being taxed twice on the same dollar. You must also consider inheritance, gift, and wealth taxes. Some countries impose inheritance tax on worldwide assets of their residents. Transferring property as a gift to a family member in another country can trigger immediate gift tax in the origin country and future inheritance tax complications. This layer requires a cross-border tax specialist, not just a local accountant. With the tax framework understood, you must navigate the legal and bureaucratic requirements in both jurisdictions. This is a two-front war. In the origin country A, you must comply with all local procedures to legally alienate the property. This involves 1. Engaging a local real estate lawyer, notary. Many civil law countries require a notary to execute the deed. They will conduct due diligence on the title. To clearing all liens and mortgages, the property must be free of debt or the transfer approved by the lender. 3. Obtaining tax clearance certificates. Most countries will not allow a property transfer without a certificate from the tax authority confirming all due taxes, property tax, capital gains, etc., are paid or provided for. For filing the deed transfer with the land registry, this officially removes you from the title. In the destination country, country B, you must comply with laws regarding foreign ownership. Some countries restrict non-residents from owning certain types of property, e.g., near borders, agricultural land, or impose additional approval processes. You will need 1. A local lawyer to advise on ownership structures and handle registration. 2. A local tax ID for the transaction. 3. To navigate currency controls, if any. For bringing in large sums of money to purchase property. 4. To understand ongoing obligations, like annual property taxes and wealth taxes. Given this complexity, your success hinges on assembling the right professional team. This is not a DIY project. You need a coordinated international team that communicates. 1. Cross-border tax advisor, your most important hire. They understand the detail letters and can model the tax outcomes of different strategies. 2. Origin country real estate lawyer, handles the legal exit. 3. Destination country real estate lawyer, handles the legal entry and compliance. 4. International wealth manager, financial planner, helps structure the financing and long-term holding strategy. 5. Currency exchange specialist, to handle large FX transfers at competitive rates, not retail bank rates. Ensure these professionals are experienced in international work and can communicate with each other effectively, with you as the project manager. In conclusion, legally transferring property across countries is a multidisciplinary project requiring strategic planning, deep tax analysis, and meticulous legal execution. The process is transparent and compliant, designed to align with the laws of multiple nations. Your action plan: define your objective. Engage a cross-border tax advisor to model the tax implications of sale versus entity transfer. Hire competent legal counsel in both countries. And secure your financing and currency exchange.